and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And there are really three primary reasons that traders trade options: speculation, income, and hedging. So I want to take an opportunity to do a series of three webcasts or three videos that address those three primary motivations. We're going to be going through two strategies for each of those from a perspective of a beginner options trader. So today we're going to be starting off with, let's call it just episode 1, which is about speculation with options. So I think this is going to be an interesting little mini series. We'll start it today. Next week I have a little bit of a different plan. So there's going to be a little bit of a pause while I address something else next week. You may want to check out next week's webcast. But then we'll go on to episode 2 and episode 3. Hope you'll join us for all three of those. Before we can dive into that, though, let me first of all say hello to everybody that's already chatting in out there in YouTube. Great to see all the familiar names. Great to see some new people out there. But hello there, Alfiero, PR451, Eva, Lola, Josh, Paul, Lawrence, Sandeep, Jay Richardson, Olga, and everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're among those that are here for the very first time, great to have you on board. And if you're watching on the YouTube archive after the live stream is concluded, well, enjoy those recordings. That's a great way to watch these webcasts. But you're certainly invited to join us in the live stream if you'd like to be here in that audience. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, as a treat for my live stream audience members, my very good friend Mike Fairborn is hanging out in the chats with us today. Mike's going to be keeping an eye on those chats, watching for questions. If I can't get to those questions, Mike's going to be there to help me out. So thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody listening to follow us on social media. You can find Mike and me on X. So you can follow Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. Now you can also follow me on LinkedIn. So you just go to linkedin.com/in. and then throw on a /Cameron May CS. That'll take you right to my profile. You can give me a follow there. But let's get into this discussion. We're going to call it episode 1, speculation, one of the primary motivations for the trading of options. But as we discuss this, of course, speculation carries risk. It's kind of inherent to the definition. So keep these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so with that stage set, let's set up an agenda for today's discussion. So as I mentioned, broadly speaking, the motivations of almost all options traders could be lumped under three umbrellas, three primary motivations or reasons for trading options. One being speculation, one being income, and another being hedging of other positions. So I wanted to walk through examples of each of those. Today being episode 1, we're going to focus on speculation. So the first thing I want to do is define what speculation is. Then we'll talk about how a trader might implement that on maybe a stock that they are following. And we'll make sure that we place an example trade before we're done today. But we're going to be covering two speculative strategies, one that's bullish, one that's bearish. So a lot to cover. Let's get into this. Let's go right to the Thinkorswim desktop platform. And I'm going to leave it here on a 1-year chart of Tesla. Let you eyeball that. Well, I just quickly address this concept of speculation or speculating. What is that? Well, speculation is when one enters into, we buy something or enter into an investment with the hope that that investment will increase over time, but obviously recognizing that there's risk that it might not. So that can happen in real estate, that can happen in fine arts and antiques, I guess. It can also there can be speculation done, certainly, in the financial markets. So we're going to be doing that with options today. So let's set a bit of a backdrop for a bullish speculation. In other words, a position that's taken with the hope that it will increase in value if a stock goes up in price. So Lisa says, when are the other episodes? So Lisa, here's the way that we'll proceed. Today is episode 1. Next week I have something else planned. And then, so in 2 weeks will be episode 2. In 3 weeks, in that third week, I guess that'll be the 4th week, it'll be episode 3. Okay, there we go. Hope you followed that. But let's set this. Let's set the sort of backdrop for what speculation with options might do for, let's say, a would-be stock trader. So how about for Tesla? Maybe our trader has this sort of an outlook. And as we look at Tesla, I think it's also fair to say, well, with options speculators or income investors or hedgers, how might they select the stocks that they choose to implement these strategies on? Now, there's not one universal truth for everybody, but there are some common threads that seem to run through the pre-qualifications for most stocks for, let's say, most traders. And among those could be price and liquidity, the price of the stock and the liquidity of the stock. Now, we're trading contracts on those stocks, but the price of the stock has important implications for those contracts, for the details of the contracts. More, let's say, pricier stocks can come with higher obligations with contracts, so the trader might be aware of that. Illiquid stocks tend to have illiquid options that can be harder to get into and get out of, so a trader might emphasize liquidity, but for some, they also emphasize what's going on with the chart. So that brings us to what we're seeing here on Tesla. Mega says, how can I set up a graph monthly on the x-axis? My apologies. If you need some one-on-one assistance, you can call 800-435-9050, our support team. But sometimes we can't address those more specific questions. It takes us too far off the topic of the intended topic of the day's discussion. So if you'll forgive me, let's get back here to Tesla. So here's what our would-be chartist might note. Tesla appears to have just been following this invisible ramp. We sometimes refer to this as a price floor or a support level, with the stock bouncing across that at bottoms and then rising up from that. And a trader who's attempting to benefit from a bullish move might look for the stock to fall back down to that sort of a support or a price floor and start to rise again. Maybe if it's shown historically that it can rise significantly off of that support, could possibly do it one more time. And if we can get that to do it one more time, there's potential in that for, let's say, a stock trader. So as an example, with Tesla trading right around $450 right now, and recently reaching highs of nearly 500. Should we just round it off and say 500 bucks? Because I think this one candle high got up to about $499. So really close. Let's say that our would-be trader here thinks that Tesla is about to make a nice run upward over the course of the next couple or 3 weeks, could possibly reach as high as 495 or 500. Well, maybe a stock trader might just buy the stock. And what they're doing there is they're speculating. They're making a guess, educated to the extent that they feel they're educated, that the stock is about to run up. And if they want, and they may want to see if they can benefit from that. There's certainly a risk that it doesn't run up. That's why we call it speculation. It's not a guarantee. Now, so a stock trader might just buy the stock and hope that those shares go up in value. But an options trader may choose to employ contracts on the stock to leverage that speculation. And so example speculative trade number 1 is just going to be a long call option. In this case, instead of buying the stock, we're going to buy a contract that gives us the right to buy the stock sometime in the near future, if we choose to. Very similar, quite different though, to actual stock ownership. And it introduces this concept of leverage. So let's go to our trade tab. And what we see here is the option chain. These are contracts of differing lengths that the trader might get into that might permit them to lock in, contractually guarantee a purchase price of the stock and in that trader's discretion. So some of those contracts might just be for 3 days. Well, that's not going to give this trader enough time. Maybe the stock just starts to move in the intended direction, or maybe it waffles a little bit for the first few days before moving in that new direction. So they may orient the time selected on the contract with how long they think it's going to take to complete the intended move. So let's say that we expect the stock to go up for the next 3 weeks or so before it gets to 495 or 500. Well, maybe we buy a contract of at least 3 weeks, and one common practice is to double the amount of time needed. So how about we go out to, let's say, the 20th of March. These contracts are 66 days. So if you're not familiar with the terminology here, with the layout of the Thinkorswim platform, this is telling us that these contracts are for the 20th of March, 2026 for 66 days, and each contract gives the trader the right to buy or the right to sell shares, and specifically 100 shares of Tesla. These are what we call standard contracts. So let me just open this up, 20th of March of 2026, and I want to explore this concept of leverage that may attract the speculators to a strategy such as buying a long call. Now, what I don't want to leave you with an impression of is that buying calls or buying puts are the only ways, or even the primary ways, or the correct ways, or the number one way to speculate. I'm using these as examples primarily because they're the, let's say, the simplest for me to explain. But there are certainly some others. Maybe I'll ask you at the end of the presentation, what are some other strategies that you can think of that a trader might use to speculate on an anticipated stock move? But in any case, let's go with the 20th of March. Next decision for the trader to make is to decide which strike price to choose. The way that I think about this is the price at which we're striking a deal to potentially buy shares from another trader. With the stock trading right around 450, one thing that we might do is just enter into a contract that gives the trader the right to buy shares for $450. And I think what we'll do, let's do that one. But I want to talk about a couple of other choices that we might have made, but we'll just call this, let me open up my scratch pad here. Let's call this speculation, not speculation, speculation strategy number one, which is a long call. And in this example, we're going to buy the 20th of March 450 call. And that looks like that's trading for between 37.05 and 37.20. Let's call it 37.15. That's we'll say that's what it's going to cost us to enter this trade. All right, let me do this. Make that bold, a little bit easier to read. What exactly are we doing here? Well, the trader is spending. Let's suppose we put in that order. And as a matter of fact, what if we were to just do that right now? Let's click on this. I'm going to click on the ask price, and that's going to create a buy order. And let's just do one contract as an example. Buying one of the Tesla 20th of March 2026 450 calls. Let's see if we can get that filled for $37.15. We'll put that as our limit. A limit order is not a guarantee that we'll fill for a given price. It's just saying that's the most we're willing to pay. Let's click confirm and send, and let's buy, if we can. Oop, our limit changed for just a moment here. Let's lock this at $37.15. There we go. Enter this order to buy one contract of the 20th of March 450 calls for $37.15. Maximum, including commissions, that would be $37.15.65. And let's send that off and see if we can get a quick fill. Okay, so what we just did here, we actually filled that at $36.95. So let's update our numbers here. Got a little bit better price than we were previously expecting. What exactly did the trader just get themselves into? Because I can tell you, we just spent $3,695.65, including that little commission. What do we get in exchange? Well, for the next 66 days, or through the 20th of March, the trader has the right to buy 100 shares of Tesla for $450 per share. Shares are trading right now for $450. But let's explore the leverage of this. I want to look at this concept. It's called delta. And now this, by the way, if you're not familiar with long calls, long is just sort of broker or trader speak for when we buy something to enter into a position. If we buy a stock, we say we're long that stock. If we buy a call, we say we're long that call. Now, I also want to talk about why is it referred to as a call? Well, it gives the trader the right. In the old days, we might have done this over the phone. We have the right to buy shares for someone else. We might have given a phone call and said, hey, I want to exercise that right to buy those shares. There we go. So it's known as a long call, but it delivers substantial leverage. I think the easiest way to relate to this is that it gives us the right to buy 100 shares, but we didn't have to spend $45,000 to get that right. If we were to buy 100 shares, that's about what it would cost us, about $45,000. Instead, we've spent $3,700, a fraction of that, but we still have locked in a purchase price of $450. And if that price goes up, we stand to benefit from that as the hypothetical trader here. So let's look at this. Let's say the stock goes from 450 up to, how about we raise this just a little bit, just to make it, let's activate our drawing. Let's say that we think the stock might go up here to 500 bucks. Nice round number, up $50. Well, if we purchase the shares at 450, if we bought the stock and it goes up $50, that's a little bit over 11% return. Pretty good return. That's about a year's worth of productivity if we're comparing it to average performance of, let's say, over the S&P 500 over the long term. So that's pretty nice theoretical return, speculative return for a stock investor. But for an options trader, we would have the right to buy a $500 stock for $450. That's a $50 per share value. We paid $37 for that, and that's a minimum expected value at that point. We have the right to buy this $500 stock for $450. It's like we're getting a $50 discount. Or in other words, this $37 investment has turned into a $50 final value, and actually it's likely worth much more than that. But that's more than a 35% increase in price. Now, Alfiero says, you're asking, are there go-to indicators to load up to view charts for options analysis? Looks like clean is better. Well, I keep it clean because my emphasis in these webcasts are typically on the sort of strategy, the options. Now, if a trader's trying to improve or learn more about charting, we may want to check out a webcast series that addresses that. For example, on Fridays, I teach a webcast. It's called Advanced Charting Techniques. And those charting techniques can be used conceptually to trade stocks or even derivatives of stocks, like options. So I'm not going to get necessarily into which technical approach is better than others, because that's really up to whether it worked or not. But yeah, if you want to learn more about technical analysis, maybe check out that Friday webcast series. Now, with this long call, I think you can see that this, let's say 11% return on the stock has been leveraged into a minimum, if the stock moves to where we think it's going to go, about a 35% return on our option. I'm doing a little bit of rough math in my head, so forgive me if I'm doing a little bit of rounding there, but it could be substantially more than that. And as a matter of fact, we can gauge, going back to this concept of delta, how much leverage the option trade has initially for the speculator here. So if we buy this contract, and in this case, we actually bought the contract for 37 bucks, our delta can tell us a couple of things. Number one, it can tell us the probability that the stock is going to be above our strike, the 450 level, at expiration. In other words, there's about a 55% chance that the stock will be above 450 at expiration. That's one way that delta might be used. But yeah, delta can also be used as a gauge of leverage. And here's how. Delta gives us a quite accurate estimate of, if the stock goes up or down $1, how much of an impact will that have on the value of the option? So if we bought this for $37 and the stock goes up $1, $1 is what? It's a fraction of a percentage point. That's barely 0.2%. what impact would that have on our option value? 55 cents. Or this $37 investment that we've made would be theoretically worth about 37.5. Now that's more than a 1% return on a fraction of a percentage move on the stock. That is leverage. Now, I'm going to be introducing a second strategy here in just a moment, but before we do that, let me first of all say, hey, thank you, Eva, for pointing out the survey that was just posted to the chat. So for those that are here in our live stream audience, there's a bit of an opportunity here for you. We don't get surveys every time in these webcasts. Sometimes we do though, and when we get those, if you would fill them out, that would be great. It's definitely valuable to your instructor. So if you do me a favor here, those that are in the live stream, click on the survey link that's in the chat window right now, and then just fill out that survey when the webcast is over. As a heads up regarding the formatting of the survey, it's a really short survey. It's just 2 questions, 0 to 10 ranking, 0 terrible, 10 fantastic. But in any case, you can also leave comments and suggestions. There's a comments box and a suggestion box. But if you take the time to fill out that survey, that data, those comments are sent right to me, and I definitely will take the time to read it. Definitely is helpful. Thanks for filling that out. Anyway, but back to our strategy here. This is just a high-level introduction to this strategy known as a long call, and it is a numbered among the potential strategies that a speculator might use. And I think you can see why a trader might be attracted to it. That's fun, but what's the risk of this strategy? What happens if the trader is wrong? What if the stock doesn't go up? What if it goes down? That's possible. That's certainly a possible outcome. If the stock goes down, now the trader has the right to overpay for shares, and they have no more time for the stock to course correct. If we buy this contract, did we settle on the 20th of March? So we'd have to visualize, we're going out beyond February here. But let's just say that by March, the stock really hasn't gone anywhere. Maybe it's gone down. And now we have a piece of paper. Okay, it's an electronic piece of paper. It's a contract, though, that gives us the right to buy shares for $4.50 that aren't worth $4.50, and there's no more chance for those shares to go up in value. That's a valueless contract. And if we have a valueless contract, our investment is lost. Yep, so that is the theoretical maximum risk of this trade. We could lose that $37, that $3,700 on a 100-share contract. So we have to be aware of the pros and the cons. Now, that's a high-level introduction to this strategy. If you want a closer examination of this strategy, I definitely have a recommendation for you. I've actually put together a series of webcasts already that go into deeper detail where I'll dedicate an entire 45-minute discussion to individual strategies. And so I've structured those as a series of lessons. Let me show you where to find those. So if you're brand new to options, if you're now getting started with options, first thing you'll want to do is subscribe to our Trader Talks channel here on YouTube. You can just click on the subscribe button down below. It doesn't cost anything to do that. It only takes a second. But this is where you can join the live streams like this one that we're having right now, or you can find playlists of previously concluded or delivered webcasts. So I'm going to go to the playlists, and I'm going to scroll down. This webcast series happens to be just circumstance. This is not like a stack ranking or anything like that, just the way they're displayed. This series happens to be down toward the bottom of all the different webcast series that we have. Getting started with options. If I click on view full playlist, all I have to do here is scroll down through these. These are listed in chronological order, reverse chronological order. So if I scroll back, I'm looking for the keywords lessons. Do you see that? They just showed up lesson 8 of 10, lesson 7 of 10. If you're new to speculation, if you're new to income, or if you're new to hedging, you may want to go back and read and watch through, not read through, but watch these lessons. Lesson 1 is long calls. You may want to check that out. All right, so what's this second strategy? Example strategy number 2 for speculation. It's taking the opposite position where a trader is trying to leverage an anticipated bearish move. So Jim says, I'm a little slow. Would you describe your leverage example again, please? Yeah, Jim, I do have time. Let's revisit that. That's totally fine. So on our trade tab here, we've entered our symbol for Tesla. We've chosen our expiration and our strike price. So if we look at this 450 call, we just bought that for $37 per share. And the question the trader might ask themselves is, I wonder if the stock were to go up, let's say I'm right. If the stock were to go up $1 in price, how might that impact this $37 investment that I just made? And Delta can give us some insight into that. Delta is actually precisely designed to calculate how much a $1 move in the stock will impact the value of the option. So if our expectation on Tesla is correct, and a stock goes up if it goes up $1, then our option will increase in price by 55 cents. It is an if-then scenario. Now, there are other variables at play. So we could go up 55 cents in value, but time decay chips away a little bit at that. So we have to be aware of that. We could go up 55 cents in value because of the price move, but if volatility drops, that will also negatively impact our options. But this is our measure of the degree of leverage according to a price move. Now, there's another big if. What if the stock goes down? Well, if the stock goes down $1, then the contract will lose 55 cents in value from what we paid for it, assuming the move happens quickly and volatility levels don't change dramatically. All right. In any case, that's what this does. It's a good measure of the degree of leverage. So if we want to throw that into a calculator, if we get, let's say, a 55% increase in value on a $36.95 investment, that's about 1.5% return. Well, 1.5% unrealized gain in the value of our contract. And that came on less than, that's about 0.25% move. It's a tiny little move on Tesla in Tesla's terms. It's a $1 move on a $450 stock is, what is that, 0.23 or something like that percent move. So yeah, a small move on the stock has resulted in multiples sized move on the option. That's that leverage that I'm talking about. Hopefully that's helpful for you, Jim. Nice thing about these webcasts, as I just demonstrated, is if you don't catch a concept, if you need a little bit of repetition with it, you can go to the archives, rewatch it, slow it down to your own pace, pause, rewind, whatever's necessary until we really get this to sink in. All right. Kayla says, once you place this trade, could you add a stop loss? Yes, we could. I'm not going to today, but yes. All right. Lisa says, which video will go into more detail about choosing the strike price and things like that? Just make sure if you go through those archives, you can look for those sorts of keywords and zero in on those. So you could just go not to X, although I'd suggest you do that anyway. You can go to my archives and, well, what you could do, let's go to the channel overall. And if let's say we're working on expiration. Which expiration to choose? Well, we can use that as a keyword search, or if we're looking for a strike price, let's say selection. We use targeted phrases here. The surprising importance of strike selection. Now this one's specifically for vertical spreads, but you can just find a webcast that's tailored to what you're trying to learn. All right, Jim, hey, you're welcome. All right, but I think we've given that quick introduction to a long call. Let's go for speculation strategy number 2, which is going to be taking the opposite approach. It's going to be a bearish strategy known as a long put. And we're going to use a different kind of a chart setup. So the pre-qualifiers, liquidity, price per share, they may be similar, Bearish traders probably want their trades to be liquid. Bullish traders probably want their trades to be liquid, but they may be looking for different behaviors on a stock chart. So how about we just look for one that's kind of the mirror opposite of what Tesla has been showing. If we look at PG, not PH, PG, there we go. You can see that its trend has been moving downward. It has been rising and falling, but generally working or stair-stepping its way downward. And look where a trader sees this price finding itself at this moment. Maybe we're kind of bumping our heads right up against a price ceiling, and possibly the trader has an expectation that the price will move toward the floor again. So really just the opposite of what we saw on that previous chart example. With both of these, though, I hope you picked up on one other thing. Right here. Thank you, Alfiero. I agree. Those archived webcasts or the filed webcasts are an invaluable resource for the learners. I think so, yeah. In any case, what does this icon mean right here? Well, possibly this trader might encounter a little bit of a bump in the road. There's an earnings announcement. It could be a bump in the road. It may be the reason for the trade. Maybe the trader thinks on Tesla, this is going to be a good earnings announcement. Maybe on Procter & Gamble, they think this is going to be a negative earnings announcement. We'll just go with those assumptions to stay consistent with the sort of the assumptions of these strategies. But I do want to point out, yeah, earnings can really spur things in one direction or the other. It can make the trader really right really quickly. It can make them really wrong really quickly. So it can lead us more rapidly toward those leveraged returns or more rapidly toward those leveraged losses. Now, let's just let that stand here as the scenario for this trade. Let's say that our trader thinks the stock is likely to go down, and maybe that's likely to be spurred by this earnings announcement. Could they be wrong? Yes. Piper says, does that look like a double bottom to you? Piper's looking at this low here and that low there. Could be. The technical assumption here by someone looking at those lows would be it's still expected to be a downward trend. Maybe instead of a double bottom, it's just a consolidation, which is a bearish behavior in price. What the trader would look for here, if you think that this might be an indication of possibly an emerging double bottom, is to get back up above the highest point between those two lows. And you see that we came up quite a bit short of that recently. So kind of a struggling double bottom if that is. In any case, don't want to get off in the weeds of technical analysis. Let's keep our focus on options. And let's do a leveraged trade here. Now, stock traders do have a choice. You might think, well, yeah, a stock trader can't trade bearishly. Yes, they can. They can do something called short selling. But I'm not going to go into what short selling is, the mechanics of that. I will say selling shares of stock short comes with unlimited risk potential. It's basically a trader's speculation that the stock is going to go down in price. Well, traders are frequently wrong. And if the stock goes up in price instead, that's costing them money. And stocks can go up an unlimited amount. There's no cap on how high prices can go. So that exposes that trader to unlimited risk. Okay? That's not today's discussion. Instead, we are going to be attempting to leverage this expectation that price will go down. So instead of entering into a contract that gives us the right to buy shares of stock, we're going to get into a contract that gives the trader the right to sell shares of stock at a prescribed price, or at a, more accurately, a selected price. So here's going to be our trade. Let's go to the trade tab. Let's stick with the same time frame assumptions. So how about we just go back here to the 20th of March, 66 days from now, and let's buy a contract with the stock trading right around 144. Looks like the closest we can get is to strike a deal to maybe trade shares at 145. That's the closest strike increment. Here's going to be our example trade here. Going to buy the 20th of March, 145 put. And that looks like it's trading between 565 and 590. Let's call it 580. What does this trade do? Well, it's known as a long put because we're buying something to enter into a position. But this contract, instead of allowing us to buy shares from someone else, or in other words, call those shares, we have the right to sell shares to someone else. Or in other words, if we have shares, we can sell those through an enforcement of that contract, put them into someone else's account and collect money from them. That's the way I think about it. It's not exactly, I guess, why this is called a put, but that's serviceable as a definition. So we're going to buy this put. We're spending $5.80 per share, but for the next 66 days or through the 20th of March, we would then have the right to sell shares for $145. So let's look at our scenario here. The shares right now are worth about $144. And if we have the right to sell them for $145, we have a $1 advantage over current price levels. But let's suppose the shares fell over the course of the next few weeks down to let's call it 138 with a little bit of rounding. Well, if the shares are down there at 138 and we have the right to sell those shares for 145, we have a $7 advantage over that expected future value of the stock. A $7 advantage that we paid $5.80 for. That would be an increase of about $1.20 in what we call intrinsic value of that contract, but that you can see the contract is growing in value because the stock is going down. That's kind of a strange concept. But let's look at our leverage here. Let's look at our actual degree of leverage. Let's look at that 145. And just as with calls, we can see the puts have a delta value. If it's helpful, think about delta. The delta starts with D, so does dollar. It's how much our contract might make or lose as the stock rises or falls $1. Now, typically, delta assumes the stock goes up. Well, if the stock goes up $1, what happens to the value of this put where we were hoping the stock would go down? It would lose 50 cents. Ouch. That's close to 10%. Well, what if it went down $1? That would increase the value of this put by 50 cents or close to 10%. It's probably about 9%. Do we want to run that through a calculator? As a matter of fact, how about we place this trade and see what price we get, and then we'll run that calculation. Let's click on the ask price. Let's buy one example put. Let's say with the natural, or basically the current market price being about 580, let's say we're willing to spend that 580 to get in. Let's confirm and send this order. Going to put in a limit order to try to buy one PG 20th of March 145 put for $5.80 maximum. We throw on the commission. That will bring our total investment to $580.65 if this order fills. Let's send that off. See if we can get a quick fill here. I'm going to go to the monitor tab and keep an eye on that order. Okay, we're offering to pay 580. It was trading at 570. It looks like we filled at 575. Okay, so this now becomes the paper money fact of the trade. We just spent $5.75 on this contract. And if we look at now our delta of 50 cents, if the stock were to quickly go down $1, the trader could expect a 50-cent increase in the value of that put. That's assuming time hasn't gone by and negatively impacted our put as well. Volatility levels haven't changed dramatically and impacted our put, but just price. Well, a 50-cent increase, let's get our calculator. 50-cent increase in our investment that we spent $5.75 to enter is, yep, about 8.7% return. 8.7% return on a $1 move in PG. 8.7% is what a stock investor might hope for on their overall portfolio over the course of a year. That's to give you a feel for how much leverage this is. And a 1% move on PG, a $1 move on PG is only about 2/3 of a percent. $1 move on $145 stock is only about 2/3 of a percent. So yeah, less than 1% move has resulted in about an 8.7% increase in the value of this put, other variables being held constant. That's a lot of leverage. So I think you can see why for speculators, they're either bullish or bearish, they might be attracted to a strategy like this. Now, with both of these, the speculation might prove incorrect. And if the stock goes up in value instead of down, well, that would mean that the trader would have the right. Let's say time is going by and the stock is just going up and up and up and up. Well, our trader now has the right to sell shares for less than they're worth. That thing needs to course correct before March 20th, or they might be left holding the bag of an empty bag of a valueless investment. All right, so guys, that is a very high level introduction to long calls and long puts. If we wanted to learn more about strategy number, let's get this corrected, strategy number 2, where might we learn about that? Well, I have a whole dedicated webcast. Again, go back to the Schwab Coaching webcasts on our Trader Talks channel. Go to the playlists and look for those lessons that I previously directed you to. So the playlists for this webcast series down at the bottom, Getting Started with Options. Let's click on View Full Playlist and scroll down and find those lessons. So lesson 1, lesson 2, there's lesson 2, long puts. Yeah, maybe go check those out. Shepherd family, you like that? Okay, now this is just the first of the primary reasons that that traders trade options. So we've talked about speculation. Next up is going to be income. So we're going to be doing that in 2 weeks. Now, if you're watching on the archive, 2 weeks from now, that means you can just go in and watch the video right away. In any case, yeah, I do have a plan that's a little bit different for next week. But we'll do income in 2 weeks, and then we'll do hedging 3 weeks from now. All right. So I hope you'll join me for those. As I wrap things up here, chat in, let me know, or if you're watching on the archive, leave a comment down below. What are some other strategies that options speculators might employ in their efforts to, let's say, leverage anticipated moves on stock prices? We've talked about long calls and long puts. That's not even close to all the different strategies that might be used. Anyway, guys, that's going to do it. Let's give you a quick reminder of the full slate of educational resources that you have available to you from Schwab. Of course, I pointed out you may want to do yourself a favor. Click on the subscribe button to subscribe to our Trader Talks channel. This is where you can join the live streams, look through the playlists, even do keyword searches. Second thing that Mike and I would definitely suggest you do is to follow us on social media. So you can find me and Mike on X. There we go. Mike can be found here at Mike Fairborn CS. You can find me on X at Cameron May CS. And I'm very active on X. I make posts like I did this one just an hour ago, commonly asking you questions about your thoughts on the markets. And we can have a little conversation here. If you reply to one of my posts, I try to reply right back to you. But I also am now active on LinkedIn. You can follow me on LinkedIn. So you just go to linkedin.com/in/Cameron May CS. So let's go here. Go to my posts and activity. There we are. Go to linkedin.com/in/Cameron May CS. Will take you to my profile. And this is where you can give me a follow. And if you reply to one of my posts here, I'll just try to reply right back to you as well. It's a great place to connect with your favorite presenters in between these live streams. There is a survey in the chat now. This is fantastic. We don't always get surveys. If you see a survey, if you do us a favor and fill that out, the survey results are sent right to your instructor, right to me. And I'll take the time to read through that survey if you take the time to fill it out. Very short survey, so it's definitely not difficult to do and certainly valuable. All right. Thanks for all the thumbs up. I can see 165 people watching, and as I refresh my screen here, I can see 63 have already clicked that like button. That's really appreciated. It's a nice pat on the back to your presenter. It also gives us a boost in the YouTube algorithm so more people can find our webcast. So thanks for all the likes. Everybody, Go have a great day. I will see you in a future webcast. So next week, a little bit of a different plan. And the second week following, we'll get into the income, which is basically reason number 2 of our 3 reasons. But I'll look for you in future webcasts. I'll also look for you on social media. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.